Paul, I mean, given that it's 10 years since the onset of the credit crisis, and given we've had a decade since then of unprecedented stimulus, at what juncture should risk spreads reflect the changing environment, this environment in which it seems central banks, do want to normalize policy?
The risk to markets from policy at this point is probably more that the policy remains too stimulative for too long. And if we begin to see that policy, let's say the Fed were to retract some of their rhetoric and continue with policy with the foot on the gas still here on the accelerator, what you could see is excessive debt being taken up. And then as the economy eventually slows, then suddenly spreads widen dramatically. So we think that that's probably more of a risk right now than if the Fed were to gradually lift its foot off the accelerator and maybe move a little bit more towards the brake. That's probably the greater risk for the economy.
Yeah, I mean, what's driving the US right now, Paul, is earnings. You've got some great stats. You say the average sector rise, excluding energy, interestingly, 4.9%. If you include energy, it's 10%. So if you dig beneath the cover, strip out energy, it's not as strong as it looks.
Yeah, that's right. I mean, some of it is year-over-year comparisons that can vary from one quarter to the next. We think the important thing for investors is to recognize that earnings will continue to grow, we believe, well into 2018, through 2018. It's still a good time to be cyclically oriented towards the markets. Perhaps on days like this, when the political rhetoric becomes a little bit more prominent, it's a good time to look for bargains, for opportunities, to take some profits where one is overweight. And we still like those cyclical sectors going forward through 2018.
What about your allocation to fixed income if you're a regular investor? Obviously, you have some allocation, but we've got a lot of, top names these days warning that fixed income is showing signs of, extreme valuation.
We think the best place to be in fixed income, keep that diversified fixed income allocation, but not to go too much into the long end of the curve. We like the middle section, the intermediate maturity, 7 to 10 years. That's a place where we think you're going to have less volatility if interest rates should suddenly start to rise.